Good afternoon, everybody. Today I'm chatting with David Garafolo from Gold Royalty. Guys, David has some pretty big experience in the gold sector, working with names such as Agnico Eagle, Gold Corp, Aris Mining, and today he's with one of the most attractive gold royalty companies in the world. In this interview, we discuss what David thinks is going to move the price of gold, why we should be excited about the gold sector as junior mining investors, and we discuss Gold Royalty, who I think have the most exciting royalty in all of North American gold mining, which of course is the Canadian Malartic Mines royalty. All right, everybody, enjoy the interview. David, thanks for joining us.
Hey, glad to be on. Thanks for having me on again.
So since we last spoke, gold prices have really rallied. I know the last couple of days, maybe they haven't been as hot, but overall, if we take a step back and we look at what's been happening in 2024, what's your view on what's driving the prices of gold here?
Well, it's multifold. I think principally it's economic fundamentals. And I'm not talking about demand supply. Those supply has been pinched with reserves declining and production declining, which has driven M&A in the sector because companies that can't find ounces are replacing them through consolidation. But I think the principal issue is that inflation is quite a bit stickier than people had assumed. The Federal Reserve and other central banks are pivoting to lower interest rates, driving real interest rates deeper and deeper into negative territory, which makes gold attractive as a monetary instrument because while it yields zero, many of the sovereign debt instruments are yielding negative on a real basis. So there's really no opportunity cost to owning gold. So that's really what's driving the flow in the gold. And central banks in principle are leading the charge in that they don't want to hold on to treasuries, particularly as interest rates are diving in negative territory and fiat currencies continue to be debased through expansionary monetary policy. That really hasn't abated. We're still seeing expanding money supply, and that's been a phenomenon that's not recent. It's been occurring for 50 years.
Do you think that when we look at what's happened around us, and I know like there's a lot of anger when I go on social media and I look at what's happened in Canada with the prices of everything and people can't afford to put a roof over their head. I'm seeing some media saying that these tent cities that we're seeing everywhere, and here I live in a suburb of Toronto where you used to never see any homelessness, and now there's tent cities all over the place. And it's a trend that seems to only be picking up and getting worse. And I wonder when I look at and we talk about what's happened with inflation, if we actually need a period of deflation to undo all of the damage that happened over the last, we'll say the COVID period, just to try to get things back under control? Or do you think that the way that the whole system's built, we really can only drive prices up or else the whole system collapses?
I think it's more the latter, quite frankly. And I know that's disappointing to hear from many people who are struggling to keep a roof over their head or food in their stomach or fuel in their cars. But it is the headline inflation numbers that we're seeing published by the various statistic agencies is a convenient mistruth. And the reason that is because they want to lull us into a false sense of complacency that they tamed inflation. But the reality is if you're looking at the important elements of our life, like food, shelter, and fuel, we're still seeing double-digit inflation. And they need inflation, they meaning governments, because sovereign debt has never been higher on a percentage of GDP, at 350% globally. And they need to inflate that away. So inflation is a necessary element of this house of cards. And if they don't keep inflation going, then these fiat currencies are going to collapse under the weight of that debt. So the debt has to be inflated away. You're going to continue to see expanding money supply in order to make the debt a smaller percentage of global GDP. And that's really been the case for 50 years. We've seen it ebb and flow, but by and large, we've seen an expansionary monetary policy really since many of the governments in the world abandoned the gold standard in the early 1970s. Gold's been a one-way trade. It's gone from $3,500 an ounce to almost $2,800 today, whereas the purchasing power of many Western fiat currencies has declined by almost 100%, believe it or not.
Now, the idea behind the gold trade used to be, we got all this inflation coming in. Here's how I can protect myself. I don't hear that narrative when I talk to, say, people on the street. If I talk to the butcher, the baker, the candlestick maker, and we talk about gold, that idea hasn't really entered their mindset. Do you think that as we continue to see inflation worsen, that we could see people start to go, I want to own physical metals now because that's probably going to be the only way that I can avoid just the overall inflation, or sorry, the overall taxes that's happening to me, whether we're talking about inflation or we're talking about just all the taxes that our government has put on us? Or do you think that we're just that narrative is gone?
No, not at all. I do think that at the retail level, which is I think what you're talking about, individuals are buying gold increasingly, and that's not only occurring in China, where that market was deregulated about 20 years ago, and gold China's become the biggest consumer of gold in the world, not only at the central bank level but at the consumer level as well, where there's a fundamental mistrust of the Chinese fiat currency. It's happening in the United States. Costco is the biggest retailer of gold right now in the U.S. And they're selling out. 77% of stores are out of gold. And it's being sold in various forms within Costco. So clearly, at the individual level, at the consumer level, and we're not talking about rich people here. Rich people don't necessarily shop in Costco. It's more the middle class and people struggling to stretch a buck to meet their needs and consumables, and they're buying gold. So clearly, intuitively and instinctively, we're seeing consumers recognizing that their fiat currencies are being debased, and they're trying to find ways to mitigate that, and by buying the physical commodity.
When guys like us follow gold, David, and I mean guys that sort of buy into the thesis, we see so much news media coming at us, and you just said it. Costco selling gold, and they can't keep it on the shelves. I think that this was a quiet TSN turning point for gold, where if I want to avoid those taxes, those indirect taxes via inflation, or the direct ones via the government, holding physical that's my ticket. That's really my ticket. And I think that 5 years ago, even the idea of where do I even buy gold or silver, where do I buy precious metals, a lot of people didn't know how to answer that. But Costco, for most Americans, I imagine, is like a regular visit, and now they know that they've got a source that they can trust to go buy it. I believe that this is a quiet TSN turning point for precious metals.
And for your US viewers, I guess it's ESPN turning point. All right. But yeah, absolutely. And frankly, owning physical has become much more mainstream since the advent of the GLD about 20 years ago. That's allowed not only individuals to buy physical or physical backed ETFs, but also it's opened it up to large institutional investors as well, whether it's pension funds and endowments who couldn't own the physical commodity. They needed to own a marketable security that was on a recognized exchange. So the GLD opened up that horizon. Arguably, though, it cannibalized demand for gold equities. And I don't think the gold equities and the producers in particular have helped themselves through the lack of a significant grassroots exploration or replace depleting reserves. So they've actually shrunk the leverage proposition for investors because reserves on a per share basis have declined among the biggest producers in the world because of the lack of exploration and development investment or reinvestment back in the business to replace depleting reserves. And so the physical has become much more attractive. And I should say, after 30 plus years of operating and building mines, I switched to the royalty model because I recognized that I like gold as an asset class, but I saw the declining leverage proposition among producers and increasing costs in the face of inflation we're seeing in the general economy. And I said, well, I want to be in something that provides unmitigated leverage to the gold price because we're top line exposure, but also has exposure to any exploration that the operators do on their existing properties.
There's also tremendous personal stress on owning a production company. Like we've gone and done site visits to companies that run mines, and you go and you see like 1,000 people working on a mine, and they have families, and you get to know them. And for yourself, David, who could be CEO, if I'm sure if you wanted to be CEO of a producing company, that you could get a job tomorrow if you wanted to. That's got to be a stressful thing when like you've sat in the lunchroom and met with your workers, and you know that the best thing to do for the company is to shut that mine down, but you know that you've got 500 families that won't be able to put food on the table the moment that you do. I think that also makes it a lot more challenging to go and like just thinking about for somebody in your shoes, that position just it just doesn't sound nearly as attractive.
Well, yeah, it was always a privilege to be able to run those mines and employ the people. And so I have no complaints in that regard. But what I would say, what you're speaking to, I think fundamentally is the difficulty in diversifying the risk inherent in operations when you're running an operating company. When I had Gold Corp under my stewardship, we had 20,000 employees and a dozen operating mines. And a dozen operating mines is not a lot of diversification. There's a limit to how much you can diversify the risk of operations away, because it's impractical for a management company to operate more than a dozen mines. There just simply isn't the management bandwidth to do more. Whereas within a royalty vehicle, which is much less, labor intensive, there's no limit to the amount of diversification you can achieve. I have over 240 royalties in my vehicle now, Gold Royalty Corp, and I could have 2,400 royalties with the same number of employees. We have 8 employees in total. There's no limit to the scalability and diversification potential of a royalty vehicle, and that's, I think, what you're fundamentally speaking to. But yeah, look, there's a lot of responsibility in running an operating company with that many employees, but it's also a significant and unique privilege.
I'm sure you've got guys in your network that are portfolio managers that manage money, and they call you up and they say, David, I want to play the gold space. What's the best way to do it? I'm your friend. I already own Gold Royalty, obviously. So let's put that company aside.
Yep.
How do I do it? Do I go through ETFs? Should I be looking at producers? Should I be looking at the biggest producers, say the top five? Should I be starting to position myself in some of those second tier assets, or should I just be exclusively focused on royalty companies? What do you tell your friend?
Well, I think there's tremendous value in the gold equity sector right now. When you look at valuations relative to where they were in major bull runs in the gold price, they've lagged the commodity, and less so at the top end of the pyramid. Some of the bigger names have actually done reasonably well, but still not performing to the kind of multiples they have when gold prices have gone through cyclical highs that we're enjoying currently. And I think that's a function of the lack of rotation of general equity investors into the sector right now. The general equity markets are still pretty robust, so they're making their money still in the big seven technology stocks and other plays like that. And so we haven't seen that kind of rotation, but I think inevitably that'll happen given the commodity performance. And in the short term, you're going to see some really gaudy earnings from some of the biggest producers, because they've gone through significant cost inflation. That seems to have stabilized right now. I think it's going to restart as we see monetary policy continue to ease. But in the short term, you're going to see some of the bigger producers perform extremely well as they put some really big runs on the scoreboard in the short term. But I think that the issue that many of them face is going to manifest itself again in that they're not growing. Many of these larger producers are at suboptimal production levels. If you look at the top end of the pyramid, and I don't mean to pick on Barrick and Newmont, but they've been the top end of the pyramid for 30 plus years. They're at the same production and reserve levels they were 30 years ago when the gold price was a tenth of what it is today. And the only thing they've been able to grow is their share count, not the share price. So per share value creation is very difficult when you're that big. It's impossible, in fact, because they're having to replace 5-6 million ounces of production per year, which means you need to find an 8 to 10 million ounce deposit every year. And that simply hasn't happened because the juniors in our space who do all the heavy lifting on exploration simply have not had access to capital. It's been a nuclear winter for juniors for a dozen years, and the industry needs them to be successful to populate their pipelines.
It's funny you mentioned that. I was talking with a broker yesterday who said that, and I don't know if it's public knowledge, but it's just something that was casually said to me, but was that Canaccord was about to lay off all their small cap brokers who are not major producers. I just look around at the space and how starved it is for capital. And The broker that I was talking to didn't happen to work at Canaccord. He happened to work at one of the other shops, and he was about to leave the space after being in it for 7 years because he just felt like there's no money flowing. And I look around, like, I'm a younger guy in this space relative to the entire junior space here in Toronto, and I don't see a lot of young guys running around the street anymore in it. There's certainly, like, almost every broker I meet is over 50. It feels like we're waiting for this time to come where the capital's gonna start flowing into the juniors, and we wake up every morning and tell ourselves it's coming, it's happening. but David, why should I have faith that that this is going to happen, and we're going to start to see this capital flow in at some point?
Yeah, history repeats itself, or at least it rhymes, right? And that has happened time and again, where what happens is the generals come in, and again, it's a prolonged run in the commodity that stimulates interest from generalist equity investors. They generally step into the large cap names because they're looking for a low risk way to play the space, and they displace the specialists who are hiding out in the large cap names right now because they're facing redemption pressure. They're not seeing significant inflows yet. But when they do, and the generals come in, they go down the food chain, the specialists do, and start to put risk capital to work with the explorers and developers. The industry starts to look for growth again. It hasn't paid for growth for quite a long time, but inevitably that'll happen when we see that sector rotation. What the catalyst will be, hard for me to say. Maybe it's a correction in the general equity markets, particularly in those very stretched valuations among the largest cap technology companies. There's a lot of hope in those companies delivering significant growth, but those valuations, I think, reflect a growth rate that just simply aren't achievable. And I think when we see that kind of correction in the general equity markets, as we have time and again, and the catalysts in the past have been the dot-com bust, it was the great financial crisis, it was COVID. There's one thing after another that kind of drives capital into the natural resource space, and that's happened time and again. And I don't know what the catalyst will be, but it will happen again, and we're going to see a reflation trade in the equities, the gold equities and commodity equities generally.
Over the weekend, Burkina Faso suggested that they are going to start revoking mining permits of foreign-owned operations in the country. I know you guys are looking at royalties all over the world. Do you think that Africa is becoming a riskier place to invest?
I think it depends on where in Africa. I wouldn't want to paint all of Africa with the same brush in the same way I wouldn't want to paint all of the Americas with the same brush. It does require a discerning eye when you go into a new jurisdiction, because when you're a royalty player in particular, you're basically holding a piece of paper, right? A contract. You're not holding a hard asset. Maybe in some ways holding a hard asset is even more difficult because you can't move it. But if you don't have confidence in the judicial framework in a country, it's very difficult to have any confidence in the enforceability of your contract. So it's very important for us, one, to focus on the geological model, the operating expertise of the people that own the asset. But ultimately, we have to have confidence that we can enforce our contract if something goes wrong. And that means we have to be very selective of what jurisdiction we go in, whether it's in Africa or the Americas or in Australasia.
So I got to sneak in a question about gold royalty here. In the first half of 2024, you guys did about $5 million in year-to-date revenues. Your guidance is calling for $13 to $14 million in revenue. Are you guys still on target to hit this?
Yeah, in fact, when you look at our non-GAAP revenue measure, which includes option proceeds on our royalty generator group, where we generate royalties, farm out the properties, and get royalties and option payments in return, we're actually well over halfway to our lower end of our guidance range. And that's without having significant kickers in the second half of the year with Côté coming into production, where we have a substantial royalty there. We've recently acquired the Varus mine, copper stream on the Varus mine in Bosnia, which has just started production and is expected to achieve nameplate capacity in the fourth quarter. And we're getting the full year benefit of owning the Borborema royalty and the Cozamin royalty as well. So really the second half is very much a big second half for us in terms of delivering the revenue we expect over the full year, which is 160% growth in revenue, I should add, relative to where we were last year. And importantly, it's the first year of positive free cash flow for the company.
What's the sweet spot for a royalty if you were to put on a whiteboard for your staff of what you're looking for to really move the company forward, that's going to get David excited at night? What does that criteria look like?
Well, right now, with over 240 royalties, we have a significant number of royalties right through the life cycle of a mine. We have 7 producing, 14 in construction, and then we have over 200 that are either in the resource stage or pre-resource stage. So we have a lot of optionality that we've already largely generated ourselves organically through our royalty generator model, through our sweat equity. Buying those type of early stage royalties, paying for those doesn't make a lot of sense when in fact we get paid to generate them. We get option payments on the properties when we farm them out, and we get the royalties for free. So why go and pay good money for that? We're more singularly focused on near cash flowing or cash flowing royalties. And if you look at the transactions we've done over the last year, 3 of the 4 have been cash flowing royalties, ones that have not only NAV per share accretion, but provide immediate cash flow per share accretion to bridge the gap between where we are today to our significant growth coming through the end of the decade, where we're seeing 60% compound annual growth in our revenue right through to 2030. And by 2030, at current gold prices, we're generating upwards of $70 to $80 million of royalty revenue. So it's more than a tenfold increase from where we were in this year, in 2024, what we're guiding. So very, very significant growth within the portfolio, but we want to focus on shorter term cash flowing opportunities to supplement the significant growth we have from some of the biggest producing gold mines in North America.
I think most interestingly here, you guys have the Canadian Malartic royalty. That's how did you guys end up with that? Like what's the backstory of how you guys ended up with that royalty?
Well, we bought it through the M&A that we did over the course of 2021 when we rolled up 3 of our competitors. And you'll recall that we had a much higher share price in 2021. We IPO'd at $5 per share, stock ran to $7. Recognizing we had a robust currency, we rolled up 3 of our competitors, and one of them was Golden Valley and Abitibi Royalties, actually 2 companies that we absorbed in late 2021. And they owned the Canadian Malartic royalty that we currently own, and they did it through their staking efforts. Glenn Mullen, the founder of Golden Valley, is a prospector, and he staked those properties. Again, that royalty generator model that I talked about, that's been very fruitful for us. We inherited it when we took over Golden Valley and Abitibi, as we did with Ely in Nevada. We have a royalty generator business in both of those jurisdictions, and that created the Canadian Malartic royalty through Glenn's prospecting efforts many years ago, prior to this thing being a producing mine.
David, if I'm an investor in Gold Royalty, or I'm watching you guys, what should I be watching out for over the next year? What's the sort of, we'll say, milestones or goals of the company over the next year?
Yeah, so we're looking at 160% revenue growth this year. So as you correctly pointed out, going from about 5 million plus of revenue last year to between 13 and 14 million this year. That's 160% revenue growth. And positive free cash flow. We had positive operating cash flow for the first time in our history in the first half of this year, but we're in positive free cash flow territory in the second half of the year, as Côté has just recently achieved commercial production. Barras is going to be achieving nameplate capacity in the fourth quarter, and we get the full year benefit of Cozamin and Borborema within the portfolio, supplementing revenue from Borden and some of the other producing gold mines that we have within our royalty portfolio. And then we have quite dramatic growth coming from Canadian Malartic, in particular the Odyssey underground extension that Agnico's investing $1.6 billion in. That will achieve full production by 2028, and we have 3% NSR coverage on the majority of the resource underground there. That means hockey stick type revenue growth from Canadian Malartic towards 2028 as they transition from open pit operations to exclusively underground, where we have better royalty coverage, but also the underground extension of Goldstrike, Ren, that has 7 gram a ton material that Barrick has stated they're going to prioritize into the mine plan at Goldstrike, where they're mining currently in the open pit sub 1 gram a ton material. And we have an exclusive royalty on the Ren underground extension of Goldstrike. So that'll represent quite a significant leg of growth for us, where we have both a 1.5% NSR and a 3.5% NPI. So when you look at it holistically, we have royalties on 3 of the 5 biggest producing gold mines in North America: Canadian Malartic, Côté, and Goldstrike. That's an enviable portfolio of cornerstone assets that, frankly, none of our peers have in the smaller cap universe. That represents 20 plus years of annuities from some of the best mines with the best operators in the world.
Yeah, Canadian Malartic. Just looking up here, that's the largest gold mine in Canada, right?
If not number one, number two.
Detour.
When it goes under, Detour, ironically, which is owned by Agnico. Agnico seems to have the monopoly on some of the best producing gold mines in Canada. But as it goes underground, in fact, it'll be producing 500,000 ounces of production from underground. It'll be the biggest underground gold mine in North America once it goes exclusively underground. But with the potential to add a second shaft to Canadian Malartic to feed a hungry mill, because they'll have 40,000 tons per day of spare capacity at Canadian Malartic when they go underground. If they sink that extra shaft, as they're advertising they will, they could go to 1 million ounces of production from underground. And then unequivocally, it would be the biggest producing gold mine in Canada. Excuse me.
Well, David, it's always a pleasure when you hop on here. I always learn a lot when I get to chat with you. So thanks for doing this, and hopefully you'll keep coming back on here in the future as you guys continue to roll out on your strategy.
Anytime. Thanks for having me on.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Also, let me know what you think in the comment section. Thanks, everyone.